Hi everyone. In this video, we'll talk about required annual report disclosures. At the end of each fiscal year, companies with public securities are required to provide shareholders with an annual report. The annual report includes financial statements such as the balance sheet. Financial statements, though, are only part of the information provided in the annual report. Critical to understanding the financial statements and to evaluating a company's performance and financial health are additional disclosures included as part of the financial statements. Some financial statement disclosures are provided by including additional information, often parenthetically, on the face of the financial statement. Common examples of disclosures included on the face of the balance sheet are allowance for uncollectible accounts and information about common stock. Information providing details of many financial statement items is provided using disclosure notes. Some examples include disclosures about pension plans, leases, long-term debt, investments, income taxes, property, plant, and equipment, and employee benefit plans. Disclosure notes must include certain specific notes such as summary of significant accounting policies, descriptions of subsequent events, and related third-party transactions. But many notes are fashioned to suit the disclosure needs of the particular reporting enterprise. Actually, any explanation that contributes to investors' and creditors' understanding of the results of operations, financial position, and cash flows of the company should be included. The summary of significant accounting policies conveys valuable information about the company's choices from among various alternative accounting methods. For example, management chooses whether to use accelerated or straight-line depreciation, whether to use FIFO, LIFO, or average cost to measure inventories, and whether to measure certain financial investments at fair value or cost. The company also defines which securities it considers to be cash equivalents and a policy regarding the timing of recognizing revenues and the estimated useful lives of depreciable assets. Studying this disclosure note is an essential step in analyzing and understanding financial statements. A subsequent event is a significant development that occurs after a company's fiscal year end, but before the financial statements are issued or available to be issued. Examples are the issuance of debt or equity securities, a business combination or sale of a business, the sale of assets, an event that sheds light on the outcome of a loss contingency, or any other event having a material effect on operations. Sometimes a company will engage in transactions with its owners, management, families of owners or management, affiliated companies, and other parties that can significantly influence or be influenced by the company. The potential problem with related party transactions is that their economic substance may differ from their legal form. For instance, borrowing or lending money at an interest rate that differs significantly from the market interest rate is an example of a transaction that could result from a related party involvement. When related party transactions occur, companies must disclose the nature of the relationship, provide a description of the transactions, and report the dollar amount of transactions and any amounts due to or from related parties. Less frequent events are errors and fraud. The distinction between these two terms is that errors are unintentional, while fraud is intentional misappropriation of assets or incorrect financial reporting. Errors and fraud may require disclosure, such as assets lost through either errors or fraud. Obviously, the existence of fraud involving management might cause a user to approach financial analysis from an entirely different and much more cautious viewpoint. As you might expect, any disclosure of related party transactions, fraud, and illegal acts can be quite sensitive. Although auditors must be considerate of the privacy of the parties involved, that consideration cannot be subordinate to the user's needs for full disclosure. Let's do another concept check question. Which of the following would be commonly reported in the Summary of Significant Accounting Policies note? A. Errors and fraud. B. Methods used to record depreciation. C. Subsequent events. Or D. Related party transactions. Please pause the video to consider the question and choose your answer. Then start the video again to check your work. The correct answer is B. The Summary of Significant Accounting Policies details key policies and methods, including inventory costing, depreciation methods, and revenue recognition. Disclosures such as subsequent events, related party transactions, and errors or fraud, if relevant, are explained in a separate notes. Okay, it's time to think about bonus points. The bonus point scatter question words for this video are the most beautiful. 3 words. The, T-H-E, most, M-O-S-T, beautiful, B-E-A-U-T-I-F-U-L. In addition to financial statements and accompanying disclosure notes, each annual report of a public company requires a fairly lengthy discussion and analysis provided by company's management. In this section, which precedes the financial statements and the auditor's report, management provides its views on significant events, trends, and uncertainties pertaining to the company's operations, liquidity, and capital resources. Although the management's discussion and analysis section may embody management's biased perspective, it can offer an informed insight that might not be available elsewhere. And remember that Sarbanes-Oxley Act of 2002 requires corporate executives to personally certify the financial statements. Submission of false statements carries a penalty of up to 20 years in prison. The compensation of large U.S. corporations that are paid to their top executives is an issue of considerable public debate and controversy. Shareholders, employees, politicians, and the public in general sometimes question the huge pay packages received by company officials at the same time that more and more rank-and-file employees are being laid off as a result of company cutbacks. A substantial portion of executive pay often is in the form of stock options or restricted stock awards. Executive stock options give their holders the right to buy the company's stock at a set price, regardless of how high the stock prices rise. Restricted stock is a unit of stock given to an employee, but that unit of stock is not fully transferable until certain conditions are met. To help shareholders and others sort out the content of executive pay packages and better understand the commitments of the company in this regard, the SEC requirements provide for disclosures on compensation to directors and executives. A proxy statement is provided each year and includes compensation information for directors and top executives. The statement also invites shareholders to the annual meeting to elect board members and to vote on issues before the shareholders or to vote by proxy. Well, that's all for this video. In the next video, we'll discuss the auditor's report. See you next time.